Okay, now we'll begin unit 15, which is real estate market analysis, and you're going to have 1% of the examination on this. So one question of 100 would be on this section. Okay, so it's a short section, and it basically goes over, what is used to analyze the market and determine what's going on in it. So what are the physical characteristics of real estate? Okay, first thing is the immobility of real estate. Okay, real estate is in a fixed location. It can't be moved. You can't pick land up and move it, right? It's fixed. Land is indestructible and durable. Structures have long lifespans on the land. However, the land has been there since the beginning of time, right? It's there. It's durable. The structures, 100 years, couple hundred years, right? I mean, as you maintain them, if you take care of them, who knows how long. And real estate is unique. Okay, it's non-homogeneous. Okay, what that means is there's no lots side by side that are ever the same. They have different elevations, they have different angles, they have different material. There's no two exactly the same lots of land. Okay. The economic characteristics of real estate. Okay. Government controls influence the market through zoning, building codes, taxes, and monetary policy. They have both direct and indirect influences. The relationship between supply, demand, and price affect everything. So supply and demand are continually changing. So, like right now, there's less houses on the market, there's less buyers. It's like going like this. It's always changing. It causes the changes in the price of real estate. So if there's not enough houses and a lot of people buying, the prices go up. If there's a lot of houses and less buyers, the prices go down, right? The market is slow to respond to change in supply and demand. So it doesn't like automatically change like that. It takes months, right? When something, it takes time for it to flow through. Sometimes years. Okay. And there's different area preferences. Okay. There's different sites, there's different areas. Some people like the beach more than the mountains, right? Some people like the mountains more than the beach. That's going to determine value, right? A condo on the beach is worth a lot more than a condo, just in a neighborhood, right? So variables that influence the supply. The availability of skilled labor in the area, construction loans and financing. Like if it's hard to get loans, the supply suffers. If it's easy for builders to get loans, supply is easy, right? Yep. Land, is there land available? And the materials. Are the materials available? Are the materials expensive? Are they cheap? We were going through that whole COVID thing, right? Materials went up, things slowed down. Like this affects it directly. All this stuff. Okay. Variables that influence demand. The price of real estate. Okay. Change in price results in inverse change in demand. So if the price goes up, demand goes down. If price goes down, demand goes up. It's exact opposite. Population numbers and household composition. So a household is any person or group of persons occupying separate housing space. Income of consumers. If income's up or income's down, it's going to affect it, right? Nobody's buying a house if they're not making money, right?
Amen.
Availability of mortgage credit. Right now, the rates are so high. People are like, whoa. You're like, hold on, right? It's a barometer of the real estate market. A small change in rates creates a large change in payment. Remember I just showed you? Today, we just looked earlier. I mean, you're talking $1,100 more for a house 6 months ago. From 6 months ago. Same house, same dollar. Huge, right?
Yeah.
In a tight money market, interest rates rise and demands drops. That's what we're living in right now. Rates are high. Demand's down. Prices haven't fallen yet. They're coming. And customers' taste and preferences. What if they don't like the style of those houses anymore? That's going to affect the demand, right?
Yep.
So your price levels. You have a buyer's market. So what's a buyer's market? A buyer's market is when the supply exceeds the demand. Okay. So that means there's 1,000 houses and 100 people want to buy them. That means those sellers are going to negotiate more to sell those houses. Seller's market is when there's 1,000 buyers and 100 houses. they're gonna outbid, the prices are gonna go up, right? Make sense?
It makes total sense, yeah.
Okay. Now, how do you interpret market conditions? There's market indicators. Okay, price levels of new home sales and number of building permits pulled. So there's indicators. So if there's a level of home sales is coming down, building permits are down. That means less are being built right now. When building permits are going up and home sales are going up, you mean there's more, right? So you can look at that and predict the future. Vacancy rates. This is the percentage of available renter units that are not occupied. So if you have a building with 1,000 units and there's 3 available, or you have a building with 1,000 units and there's 100 available, it tells you where the market's going, right?
Yeah.
You can use that to anticipate. And sales volume, number of homes sold. Right now in Fort Lauderdale, the amount of sales this year compared to the amount of sales last year is about 800 million less. And about 30% more less houses from year over year. What's that tell you is coming? Less, right? It's going down, right? So now we got to look at calculating occupancy rates. You want to know these calculations. So if you have a building with units in it, you got to take the occupied units divided by the total units, and that will give you the occupancy rate. That's how many are filled. So if you say you have 300 apartments are rented in a 375 unit building, what's the occupancy rate? You take 300 occupied units divided by 375, it's 0.80. That means it's 80% occupied, right? Pretty simple, right?
It is,
And
right?
let's look at vacancy rates. You have vacant units divided by total units, and that equals 0, the percent of vacancy rates. So example, 320 apartments are rented in a 400 unit building. What is the vacancy rate? So you take the 400 units, you subtract the 320 rented units, and that gives you 80 vacant units. You take 80 vacant units divided by 400 units, it's 0.20. You have a 20% vacancy rate. Does that make sense?
Makes sense, yeah.
Pretty simple calculations.
Yep.
Very, very short chapter. It just talks about how supply and demand works. And you have any questions on that?
No, I'm surprised we're done. Jesus, I was
Very
short.
simple, very quick. Something you want to think about with this is the supply and demand. Questions on that. What affects the supply? What affects the demand? Something like that. All right, so let's go into the next one. We'll go right to it. Real estate appraisals. Okay. So we're going to have, let's see, you're going to have 8% of the test on this. So 8 questions out of 100 are going to be on the appraisal section. Okay. What I'm going to do, let's take our 10-minute break, and then we'll run this all the way to the end. We'll take a 10-minute now. We'll go all the way to the end. And I don't know if we're probably not going to finish this today. We'll take the 10-minute break. We'll come back. We'll start this, and we'll go as far as we can. Okay.
Sounds good.
Perfect. Okay, we're going to resume on section 16, real estate appraisal, and 8% of your examination comes from this section. So 8 questions out of 100. Okay. So appraisal regulation, obviously they're regulated by somebody, right? So Financial Institution Reform and Recovery and Enforcement Act is the act that handles appraisal regulations. There's the Appraisal Foundation, which has the Appraisal Qualifications Board and the Appraisals Standards Board. Okay, then you have your state certified appraisers. They're certified residential appraisers and certified general appraisers. Okay. So when it comes to federally related transactions, Okay. Real estate related financial loan transactions that have to do with the sale, lease, exchange, financing. It involves federal financial regulatory agencies, FHA, VA, conventional, right? This is the federally related transactions like we talked about before. It requires services of state certified appraisers. So they have to be a certified residential appraiser or a certified general appraiser to appraise for those types of transactions. Okay, they must be in writing and they must conform to the US PAP rules and regulations, which we're going to go over in a minute. It also includes appraisals for Fannie Mae, Freddie Mac, FHA, and VA. Like we talked about all of those people are going to require state certified appraisers. Now, the US PAP form, the US PAP, the organization, it is the Uniform Standards of Professional Appraisal Practice. This is what is the guidelines for the industry. It sets the guidelines for the appraisal services. Okay. It requires objective and impartial appraisals. It establishes record-keeping requirements. It creates confidential appraisal client relationships. And it's unethical for them to accept compensation based on a value. They base it on the square footage of the house. They base it on different things, not on the value. Because if it's on the value, they're incentivized to give a higher value to make more money, right? So usually it's square footage of the home or building. So if you remember in the Florida statutes, right? Part 1, chapter 475, Florida statute and appraisal services, right? Part 2 actually is all appraisals, right? Part 1 in this section, though, has about appraisal services. Licensee may perform appraisals for compensations. So a broker can perform appraisals. However, it can't be for one of these organizations that require state certified. They must abide by the US PAP guidelines. They cannot perform appraisals for federally related transactions. They cannot refer to themselves as certified appraisers. And CMAs and BPOs, we talked about those before, they do not have to comply with the US PAP guidelines. They're not appraisals. They're estimates. That's how you figure out values of what to sell for, things like that. They're not appraisals, okay? Can't be referred to as an appraisal. So let's look at the concept of value. There's different ways to approach the value of property. Okay, you have a cost approach. That's an expenditure to create and improve. That's the labor, the materials, the land, like what it costs to build a house, right? Price is the amount paid by the contract price, like what the houses are selling for, what the contract price was on them. And value, what it's worth to many consumers at a certain time. Okay. So types of value. You have the assessed value. Assessed value is what they use for property taxation. You have the insurance value. That's a replacement due to a catastrophic event, hurricane, tornado. You have an investment value, what an investor will pay, right? So an Airbnb property may have a higher value because they're making more money on that than a normal investment property, right? That's an example of investment value, right?
Yep.
You have liquidation value. This is when a property is being sold for rapid sale. Going concern value. That is only on income property. Going concern is only when you have leases and you're collecting rent. It's income producing. And salvage value is at a property's end of structure, useful life. It's fallen apart. It's just worth what it's worth, right? So let's look at the market value. Well, what is market value? How does that come up? What is it? It's the most probable price a property should bring in a competitive and open market under all conditions requisite to a fair sale. It assumes the buyer and seller each act prudently and knowledgeably, and the price is not affected by undue stimulus. Somebody's getting divorced, somebody sick and has to sell a property, things like that. None of that is in there. It's just what the market allows it to do. Now let's look at some assumptions in market value. So the value applies to a specific date when the title is transferred. So the appraisal, the value that's done at that day. 3 weeks later, it could be worth something else. It changes. Some catastrophic event could happen and a neighborhood gets annihilated. Look at Hawaii. Hawaii, those homes are worth money. They burn down. They're not worth nothing the next day, right? That's something like, so the value applies to now. We don't know what's coming. Buyers and sellers are typically motivated, right? The buyer wants to buy it. The seller wants to sell it. Both parties are well informed and well advised, and they act in their own best interest. They're not going to sell a property for less than the seller's not going to give it away. The buyer's not going to overpay, right? They're acting in their own best interests. A reasonable time is allowed in the open market. Payment is made in cash, in US dollars or comparable financial arrangement. And price is not affected by special financing or seller concessions. So they're not going to raise the price to give the buyer money. They're not going to raise the price to get, a different rate or different thing or appraisal or sell or, it's not affected by any special anything, right? So let's look at the characteristics of value. What determines the value? The acronym is DUST. Demand, is the property in demand? Do a lot of people want to be there? Utility, is it usable? Is it hard to use? Is it easy to use? Scarcity, is there a lot of them? Or is it something very unique? And transferability, can it be transferred? Is it sellable? Are there any issues? Those characteristics are what determine the value of the property. Now, there's something called the principle of substitution. So this means a prudent buyer or investor will pay no more for a property than the cost of acquiring through purchase or construction an equally desirable alternative property. So it sets the upper limit. So if there's 3 houses in a neighborhood for sale and 2 of them are 200,000, one is 300,000, and they're all the same house, an investor's not going to pay more, or a buyer's not going to pay more than 200,000 if the other houses are the same. Or if they could build one for 200,000, why would they pay 300,000? Right? It doesn't make sense. That's called principle of substitution. Okay. Now you have the highest and best use. So what's the highest and best use is the most profitable use of a property must be legally permissible by zoning, physically possible by soil type, shape, size, and slope, buildable, financially feasible by income being generated, considering the cost of the improvements. Okay, so if you have a home on a corner of a busy intersection and it's zoned commercial, but it's a residential home, right? But it's commercial residential, you can knock that home down and put a gas station there. That's the highest and best use, right? So like you got to figure what's the highest and best use for this property. That's the conversation I'm going to have with this guy today at 4:30 that's coming in. He owns a gas station, it's run down, but it's an industrial property on the corner of a very busy intersection. So it's not going to be sold for the gas station that's there that's no longer activated. It's going to be sold for what can be there, right? So highest and best use. So as through vacant land, how does this concept work? The legal use of a site that would produce the greatest value, like I just explained, the gas station industrial, right? Is the potential highest and best use of a site determines its value. As improved, like if it's just vacant land, that's what you're looking at. As improved, how a site that has improvements on it can be best used. Should the improvements be demolished, renovated, or retained in the present condition? Like this gas station, they already took the tanks out. It's a convenience store now. They should knock that down, clear it out, and build something that they're going to do. That's what the buyer's probably going to do. They're not going to use the convenience store there. Does that give me an example of how highest and best use works?
It definitely does, yeah.
Okay, so you have more principles of value. So you have increasing and decreasing returns. Okay. Over improvement occurs when an owner invests more money in a structure than the owner can reasonably accept the recapture. Okay, so that's when you make the house super, super nice. You're never going to get the money out of it, right? So you overpaid. You overdid it. Conformity. Are the properties all similar? Is it like townhouses in a neighborhood? Do they all conform? Okay, that could be good or bad, right? Depending on what it is. Assemblage and plottage, okay? Assemblage is the combining of two or more adjoining properties to increase the usability and value. And plottage is the increased value resulting from the assemblage. So if there's 15 partials of land and a builder wants to build a development, he can buy all 15 partials. That's called assemblage. It makes them more usable and more valuable, right? And plottage is the increase that resulted from it. So they bought the 15 acres or 15 lots, put them all together. Now they're building something. The plottage is what it's now worth. That's the increase, the value of what they did. So assemblage and plottage work together. And you have progression and regression. People moving to an area brings the value up. People leaving an area takes the value down, right? It's going backwards, regressing or progressing, right?
Quick question for you.
Mhm.
In assemblage and plottage, would that be the land? Would that be the land terminology for like a fix and flip kind of?
No,
Like,
this is combining land to make it more valuable. Buying two farms and making them a development.
got it.
What do you mean by fix and flip though? What do you say? Like you're saying,
Well, let's say as a business model, you know how fix and flip is like a business model where people buy a property and they fix it and then they sell it for a larger amount or
yeah,
they
yeah,
increase the value.
yeah.
Sometimes they don't even sell it. They buy and hold, for example, and they just keep it up. They just
Rent them and they make, and as the value goes up, they make money. Yeah, yeah.
yeah, right. So that my assumption, because I'm really trying to like link the concepts
Yeah,
to the
no,
things
no.
that I already know.
It could be a long-term investment. Like if you say, hey, I want to buy all these pieces of land and hold them, you could do that.
Yeah.
They're making it worth more. Yeah.
Or you can buy all these pieces of land. Let's say that you buy them for like 10K a piece, and there's three of them. And then as you put them together, instead of being worth 30,000, now they're being worth 50,000.
Yeah.
Just because they're together.
And that would be the plottage.
There you go. So yeah.
That would be the plottage. Now, what you do with them is up to you. It doesn't matter what you do with them.
Yeah.
Yeah, for sure. So let's look at the three approaches to estimating real property value. So when they do an appraisal, there's three approaches that they use to figure the value. Appraiser will use all three approaches to estimate a value if sufficient data is available for each approach. They'll use a sales comparison approach, a cost approach, and an income approach. Okay. Now let's look at these approaches. Okay, so as we were saying, we had the sales comparison approach, the cost approach, and the income approach. This is the value approach to determine the value of properties. And these three approaches are used when possible. Now, if it's not an investment property, the income approach probably won't be used, right? So let's look at the relevance of each approach. Okay, you have the sales comparison, which is vacant lots in an established neighborhood of single family dwellings. You take houses that are alike and figure out what they sold for. Income approach is what the rents are being collected on income producing properties. And cost approach is for newly constructed houses to cross-check other approaches and special purpose properties. Like if you're trying to figure out a value of a church, there's no other building like that church, right? You got to look at the cost approach. That might be a question on a test. You might see a special property that's unlike anything else. What would they use? Cost approach. Like, that, right? Because there's nothing else to compare it to. There's no sales. There's no income, right? It's a unique building, right? City Hall, things like that, right?
Makes sense.
So let's look at the sales comparison approach. Value is estimated by reviewing recent sales of comparable property, they call comps, similar to the subject property. Sales must have occurred recently in the same market, usually within 3 to 6 months, at the most a year. Comparable properties must be similar to the subject property. Adjustments are made. So transactional differences are also considered. Changes in market conditions since the date of sale. Something that sold 3 months ago is worth less today because the rates are higher, right? That's something like that. And property differences, square footage, location, and so forth. Okay. How many bedrooms, how many bathrooms, right?
So built.
Year built, yeah. So let's look at the adjustments. What you have to remember, the adjustments are never made to the subject property. Adjustments are made to the comps. The subject property never changes. So if the comp is better, a subtraction is made on the comp. If a comp is inferior, something is added to the comp. Okay. So let me use an example. Subject property, 3-bedroom, 2-bathroom with a pool. Comp, 4-bedroom, 3-bathroom, no pool. So you have to take the comp, you got to take 1 bedroom off, you got to take 1 bathroom off, and you have to add a pool. Right? The subject you don't change. The comp changes to match the subject. So you subtract the price of a bedroom, subtract the price of a bathroom, add the price of a pool, right? That's that concept right there. Okay.
Got it.
So adjustments for these transactional differences. Financing terms. The appraiser adjusts each comparable for special financing term, like seller paid points. Like if seller pays closing costs, that will affect the, say the seller gave $10,000 in closing costs to the buyer. That would reduce the sale price 10 grand for a comp, right? Because that 10 grand came out, right? Conditions of the sale. Appraiser must research for abnormal pressure on the buyer or seller. House sold for 50 grand under market. Well, somebody passed away and they sold it, estate, or somebody's getting divorced or something. They got to research it and try to find out. And market conditions. Appraiser adjusts sale price for each comparable if the market has changed since comparable sold. Something 3 months ago that was 400,000 might be 380 today because of the rates, because of the market, right?
Makes total sense.
Also, square footage. Appraiser will adjust the sale price for each comparable based on whether the square footage is larger or smaller. Landscaping. If somebody, you can spend $100,000 on landscaping. If somebody has landscaping that has palm trees and all, of course, that is going to be either adjusted or added, right? If the comp has beautiful landscaping, you have to add that to the other ones. Or, I'm sorry, the subject. If the comp has beautiful landscaping, the subject doesn't, you have to take it down, right? So reconciliation. So each comp sale price is adjusted for the difference between the comp compared with the subject. Each comp is rated in terms of its similarity to the subject. Rating is reflected in giving weight to each comparable. The weighed comps determine the indicated value using the sales comparison approach. Okay. So if comp number 1 is 50% like the house, and comp number 2 is 25%, or 40 or 30%, and comp number 2 is 20, the value of 1 would be 50. You would take the percentage of each one and add them together. I'll explain that to you in some questions that we do later. Okay. Does that make sense? Okay. So now we're going to continue unit 16 on appraisals on the cost approach formula. So we did review the sales comparison approach. Now we're going to look at the cost approach. Okay. So the cost approach, number 1, is an estimate for a reproduction cost. Okay. So you subtract your accrued depreciation to derive the depreciated value of the structure. So there's going to be depreciation for the time, the age, and you calculate that. So you take the reproduction cost, calculate the accrued depreciation, okay, and subtract it. Then you take the estimated value of the land and add it to it. And then you add land value to depreciated value of the structure to derive the indicated value of the property. Okay, and we're going to go into more details of this. So let's look at step 1. This is where you estimate reproduction cost. Okay. So you have a couple different breakdowns for this. You have 1, you have reproduction cost. Number 2, you have replacement cost. And then you also have an estimate cost. Okay. So the reproduction cost is the cost to duplicate a structure exactly. Same countertops, same wall, same everything is reproduction. Replacement cost is to build the structure with the same use and function, but not an exact copy. So it might be a different flooring, might be different, different things, but it's the same house. It's just different look, right? Different materials. Okay. So reproduction is exactly. Replacement is same thing, same function, not exact. Okay, and then you have estimate cost using, okay, so you have a comparative square foot. Okay, so you look at a comparative unit or a unit of comparison, and there's a cost estimation handbook that they use. And the cost estimate, the handbook lets them estimate the cost based on current cost to construct a building of the same size, design, and quality. So if the handbook will say, you know, it's $189 a square foot for, you know, this type of property. They have calculations for it, and that gives them an estimate. So that's how they look at the reproduction cost, one of these ways here. Okay. Now, once they do that, they have a number. And then the second step is you got to subtract the accrued depreciation. So what's accrued depreciation? Okay, accrued depreciation represents the loss in value between the subject and an exact new replica. One thing you have to remember, land is not depreciated, only the structure is. So the land value is the land value. You never depreciate anything off of that, right? The land, because there's nothing that depreciates. It's not like the roof goes bad or, you know, you need new windows. There's nothing coming off the value, right? After so many years. Okay. Now a defect is curable if it is cost effective to correct. Okay. If it increases in value as at least equal to the cost of correcting. You can look at that as like a car too. You get in a car accident. If a car is too much to repair, they total it, right? They're not going to pay $10,000 if the car's only worth $5,000, right? So it's the same concept, but just with a defect in the building, right? Hurricane comes through, knocks down the walls and roof. The house is 1960, and you know it's just, if it doesn't make sense, it just depends if it's curable or not financially, right? So that's an example of that. Okay. So let's look at the types of depreciation that you have. Okay. You have physical deterioration. That's loss in value due to ordinary wear and tear. And this is called by use, lack of maintenance, exposure to the elements, right? That's like a roof that's 10 years old, you know, or 20 years old, right? You'll have the deterioration on that, right? You have functional obsolescence. You got to remember this. Functional obsolescence is loss due to operational inadequacies, poor design, or changing tastes. All over improvement is also a functional obsolescence. If you put all this money into the house and make it like the Taj Mahal, and the neighborhoods, you know, it doesn't, you're never going to get that money out of it because you put so much money into it. There's no comps that are going to be that high, right? Because of what you did to it. That's called over improvement. That's called functional obsolescence. It's functional. Also, if you have a house, okay, and you have to go through one room to get to another room, right? That would be functional obsolescence. It's like, so some people may not want to go through one bedroom to get to another bedroom, right? That's functional obsolescence. It depreciates it. Okay. And then you have external obsolescence. Okay. So functional is created by you, by somebody. External obsolescence is a loss of value due to something outside the property lines. Let's say they put a recycling plant across the street from a development. That recycling plant, you have no control over it, but it's going to hurt the property value. Does that make sense?
Yes,
So
it does.
if it's outside the property lines, it doesn't, you didn't have any control over it, but it's going to affect it. Okay.
Got it.
So you have physical deterioration, functional obsolescence, and external obsolescence. You need to know those three. Okay.
Got it.
And then you have the age life method. Okay. The majority of appraisers take into account the observed condition of the subject property. Okay. Give me a second. Let me turn that off. All right. There we go. Okay. Okay. The majority of appraisers take into account the observed condition of a subject property. Okay. Based on a ratio of the property's effective age indicated by structure's condition and utility to its economic life. Total years of structure is profitably useful. Okay, so they're going to look at that and see the wear and tear, and they're going to say how much age is left. They'll say the roof has 10 years left, you know, Now, a house can be 100 years old, but it be in great condition, right? The real age of the house isn't an effect. It's the condition is what they're looking at here. Okay. Now let's look at the accrued depreciation formula. How do you figure this out? Okay. So you have the effective age divided by the total economic life. And then you multiply that by the reproduction cost new. And that'll give you your accrued depreciation. Okay. Now the alternate accrued depreciation formula would be the reproduction cost new divided by the economic life, and that will equal the annual depreciation. And then you take the annual depreciation times the amount of years that it's effective. How many years are left good on the property? And that's the estimated total accrued depreciation. It's the same answer, it's just different math, right? Okay. So now you have step 3 and 4. That's your cost on the cost approach. So this is where you estimate the land using land value using sales comparison approach. So this includes non-structural site improvements. So you add the land value to arrive at the final value. So you're going to look around, compare it, find out what the land's worth, and then you take that value you came up, you take the reproduction value, the replacement value, subtract the depreciation, and then you would add in the land value, which is here. And then that's it. That's how you come up with the cost approach. So cost to fix it minus any of the wear and tear and everything else. So it's equal. And then you add the land value to it. And that's how the cost approach has come up. Do you have any questions on that?
No, I would need to,
You have to review, but it's pretty clear. Yeah. I mean, it's like okay. And let's go to the last one. You have the income approach. Okay. This measures a flow of income projected into the future. Okay. It's the market value is estimated based on the present worth of future income for the income property. So what kind of income do you have? Now you need to know this because there's going to be some math problems on this. There's the gross income, effective gross income. There's 2 calculations for this for different areas of real estate, but you need to know how this is calculated and what it is. So you have the types of income are potential gross income. That is the annual income if the property is fully rented and there's no collection losses. That means it's rented all months out of the year and nobody misses a payment, right? That's your potential gross income. That's the most you can make. Okay. Then you have your effective gross income, your EGI. So you have your PGI, you have your EGI. That's your effective gross income. And how do you calculate that? It's your PGI minus any vacancy and collection losses you have. So if you have a building with 4 apartments, and let's say one of them was empty for 2 months, and let's say one person didn't pay you for 2 months, right? You would subtract those losses, but then you also add in non-rental income. So you know how complexes have washing machines and dryers and you pay for them, and they have vending machines and things like that. That would be income that's non-rental. So to get the EGI, you take the potential gross income was the most you can make, subtract the vacancy and collection losses, and then you would add back in anything from the washing machines and vending machines, and that would give you your effective gross income. Okay. So potential gross income is most you can make. Effective, you take out the vacancy, collections, and any non-rental income gets added in. Now you have your effective gross income. Then the next income is your net operating income, NOI. That's what you want to look at when you're buying property. You want to know what the NOI is because that's your return on your money. So you take the effective gross income, subtract the operating expenses, okay, for the property, and that will equal your net operating income. So you're taking the money that you make, subtracting all the costs and all the whatever out and adding in any other income, and then you're subtracting the expenses from the building, and then the NOI is going to be what you make. That's what you have for profit, okay? Your net operating income. Okay. So let's look at what are operating expenses. So you have, it says operating expenses, right? So you need to know what operating expenses are and aren't. You are questioned on that. Okay. So there's 3 types of expenses that contribute to operation of property. Okay. The first one is your fixed expenses. The second one is your variable expenses. And the third one is your reserve for replacements. Okay. So your fixed expenses would be your property insurance, your hazard insurance. Now, we know they're not fixed, right? Property taxes go up, hazard insurance goes up, right? Things like that. However, you have a policy amount or a tax amount, and you know every month what it is for that year. So it is a fixed expense. Just you have to remember it that way, okay? So fixed expenses like your property insurance and your property taxes, okay? Variable expenses would be like your maintenance, because you don't know how much work's going to need to be done, your utilities, supplies, things like that. They're your variable expenses because they change, they go up and down, right? And then you have your reserve for replacements. Okay, this is allowance for future replacement of building components. Let's say you have a 10-unit building. You need 10 air conditioning units, right? You need 10 water heaters, and every 15 years you got to replace those. So you know how much it's going to cost you every 15 years or whatever it is. So every month you would divide that amount for all those units and divide it by, 15 years, 180 months, and it'll be X amount a month. And you would take that money and put it in reserves. So when the time comes, you have the money. It's not like a thing you need, right? Or you get stuck paying a lot of money at one time. You're actually putting it away every month for the property. That would be your reserve for replacements. You know, the roof needs to be replaced in 30 years, right? So you need to put that money aside. So these are the operating expenses you have when it comes to investment property, right? So now what you need to remember, not included in operating expenses, and you get questions on this, okay? Depreciation is not an operating expense. Cost of mortgage. The mortgage is not an operating expense. Personal expenses is not operating expenses. Income taxes are not operating expenses. Any expense that does not contribute to the operation of the property. You cannot put any expense in there that is not contributed to operating that property, right? Mortgage is not. Personal expense, no. Taxes, no, right? Income taxes, no. Property taxes, yes. Income taxes, no, right? Now, here's how you can remember this formula, okay? So you have the I equals net operating income, R equals capitalization rate, and V equals value or sale price, okay? So if you're looking to get the net operating income, you have to take the rate times the value. If you're looking to get the rate, you got to take NOI divided by value. And if you're looking for value, you got to get NOI divided by rate. So if you have a question and they give you the rate, the value, and they're asking what the NOI is, you know you have to figure out rate times value because NOI. Now, the way you remember this, you draw a triangle, you put an I, you put a line through it, and R times V. Okay? So what you do is, if you're looking for NOI, you cover up the I. What do you got left?
R times V.
R times V equals NOI. You see that?
Yeah.
You want the rate, right? You want the rate, you cover up the R. What do you got?
I divided by V.
Right. The lines of division, right? I divided by V, right? So I divided by V. And if you want the value, you cover the V. What do you got?
I divided by R.
Right. I divided by R. So all you got to do is remember, draw an I, put a line, and R times V. And whatever the question is asking you in this, just cover the one in your head and know what it is. And then do the math, you got the answer. You just got to remember it's I over R times V. And if they want the rate, cover it, I divided by V. If they want the value, I divided by R. If they want the NOI, R times V. And you just take the two numbers in the question and multiply them or divide them. And then the thing is, the answers will be the answers for all the calculations. So if you get the wrong one, it'll still be there, right? Because they're gonna try to trick you with the wrong one in case you divide wrong or add wrong, right? Or multiply wrong. So you just got to remember I over R times V. Okay.
Okay.
All right. All right. Now let's look at the reconciliation of the final values. So once they do all this, how do they reconcile it? So the appraiser gives weight to each approach value, usually a percentage. So if they use all three approaches, they'll say 50% sales comparison, 25% cost approach, 25% income approach, right? They'll break it down into percentages. An appraiser who uses all three approaches for a single family home may give higher percentage to the sales comparison approach than the other two because it's more accurate, right? Actual sales comps are a better indicator of the property's value always, right? Obviously. Okay. Now let's look at gross multipliers. Okay. So gross rent multiplier, the GRM, is the ratio between a property's gross monthly rent and its selling price. A gross income multiplier uses annual income, which includes income from rent and other sources. Okay, this is in calculations. So let's look at the gross rent, the GRM steps are. Okay, so if you're looking at an income property, you estimate the gross monthly rent for the subject property. You calculate a market-derived GRM by taking sale price of comparable properties and dividing the gross monthly rent. So if you're looking for an income property and you're taking a house that's not an income property and you want to compare it, you have to do this to make it as if it was an income property. So if you look at a house that's sold that was just a single family home, if it's a single family rental, you take the sale price, you divide it by the gross month rent, right? Like what the rent is for the property that you're looking at. And that'll give you the rent multiplier. It's like 0.41. It's like a long number. And then what you do is to calculate the average GRM from several comps, you take this, you take the gross monthly rent multiplier, okay, to estimate the value of the subject property. So you take the monthly rent and times the area GRM that you take three houses and you get that multiplier for all of them, right? And then you multiply that by the monthly rent and it gives you the estimated market value. It's like a backwards calculation. So if you're looking for a investment property, does that make sense to you the way I explained that?
I'm struggling to kind of put it into perspective.
I'm trying to, it's a little confusing. So, okay. So if you have a sale price of a house, you can write this down as I'm talking to you, right? So let's say you have a sale price of a house. One is 300,000, one is 325,000, and one is 275,000. Okay. Let's say the rent for the property is 1,900 a month. Let's just put that on a separate piece there.
For which one?
Just say the one we're looking at. It's just 19. You don't have to figure for all of them.
Okay, 1,900.
Right? So what you want to do is you take the sale price divided by 1,900. So let's take 300. Take the one that's 300 divided by 1,900.
Okay.
Okay, what do you got?
About to. Give me a second.
Yeah, I'll do it. I'll do it here for you on the screen too. 300,000 divided by 1,900. I think that's the way it goes. Nope. Hold on.
157.89.
100 divided by 3. Was it 3? What did I say? 300? It's 0.006333. Okay. So your gross rent multiplier is that number. Okay. So let's say the rent. So 0.0. I'm gonna shorten a little bit. Let me just take this number here, okay? Just to do what we're doing here. Okay, so 0.0663. Okay, so now that's the rent multiplier for that house. That's what if it's 1,900 for 300,000, that's what it gets. Now, if we take this number and we multiply it by 275,000, that's what the rent should be for that house. If it's the same, you follow what I mean?
Yeah, kind of. Yeah.
So the rent multiplier allows you to make the houses equal pertaining on the sale price. because this multiplier here, this number, if it, let's say the house was, let me go back. So, oh no. Okay, so let me go divided by 275. Okay, so it was what was it? 0.06333, something like that.
0063.
0.0063333, whatever, right? So let's say it's $1 million house. And you want to figure out that's the multiplier. So no matter whatever the house is, that's what the rent should be. So let's say it's $1 million house. You see how we figured that? So you take the price of the house divided by the rent, and it gives you this number. Then you take this number and multiply it by whatever the value of the house is that you want to find out what the rental should be, right? And you take that and you multiply by $1 million. So this will tell you what the $1 million house should be rented for. $6,333.33 for that neighborhood, right? Because that multiplier, depending on what the house is worth, right? If it was 500,000, it'd be half of that, right? If it was 250, you follow how that works?
Yes, so I follow the process, but one thing that I am struggling with is finding out which property we are getting the multiplier from. Is it the subject property that is already a renter?
Yeah, whatever property you're trying to, like the comps. So let's say the property, okay, the property you're appraising, they're getting $1,700 a month, and it's worth $275,000, right? Right? Let's just say that you're appraising a property. It's an investment property. They're collecting $1,700 a month, right? So you're taking 1,700 and dividing it by 275,000. Here's your gross rent multiplier, right? Now, let's say you're using a comp down the street that just sold, right? But the comp down the street you just sold is not a rental. And it's sold for 300,000. But it's not a rental. So how do you give it a rental value? Because it's not a rental. Somebody's living in it, right? The owner's living in it. But you want to use that comp. So you have to, so you figure out, here's the rent multiplier for the 1,275. See it? If that house was a rental, but it's not, just like if that house had a pool, we have to add it, right? Same thing. If that house had a renter at this rate, okay, that house value would be, so you multiply that by 300,000. The rent for that house would be 1,854, not 1,700. You see me? How I do that? So when you're doing the income approach, you got to turn a single family home that's not a rental into a rental for comparison purposes. That's how you do it. Now do you get it?
Yeah. So if there is another house that is not a rental, but we know the market value for,
right?
And we want to know what the rental potential would be, then we would multiply the rental.
And the way you figure that out, is you take the rental that you have and divide it by the price of the house, and it gives you the factor.
Gotcha.
The multiplier. And then that's how you can take it to any house. You can take it to $1 million house. You can take it to anything and say, that's what I'll pay for it. So if somebody's asking $2,100 for a rental and you got 3 comps that show it should be 1,800, you show them, well, here's this, here's this, here's this. Here's what I'm willing to pay for that. You know what I mean?
Gotcha.
That's how you can figure that out, right? So that's the gross rent multiplier. Does that make sense to you?
Yes. Gross rent multiplier.
Yep. All right. And the last thing we're going to talk about in this section is the comparative market analysis, the CMA. Okay, licensees prepare CMAs to help buyers and sellers make informed decisions. Okay, so when you do a CMA on a property that somebody wants to buy or sell, you're giving them a rough idea of what it's worth. Okay, we're going to be preparing CMAs and reports. Like when you make calls and set appointments for me, you're gonna prepare those and you're gonna send them to them, which I'm going to show you how to do that. Okay. It's not an appraisal report. You can't tell them it's an appraisal. You're going to tell them, I'm going to do a property report. I'm going to do a market analysis for you. I always tell them a property report. And I'll explain when we go through our training for that. I'll show you all that stuff.
Yes.
There's three major categories of comparables. So when you're looking at a house to sell or a house to buy, what you do is you look at what recently sold, what's currently on the market, and what expired. What's recently sold shows you what they're selling for. What's on the market is what they're asking. Are they asking higher or asking lower? And expired listings show that they were priced too high. So you know from those three things what you should be offering on a house. Okay. So a CMA, an agent can do, you cannot call it an appraisal. That's a violation. You cannot do that. It's not an appraisal. Okay. And that'll be the end of unit 16.